Hey guys, it's Sasha. This isn't going to be one of my usual videos because I want to show you something really interesting happening in the stock market right now. This is a combination of data and trends that nobody else is talking about. It is really important and it will make you think differently about your investing. And there is a reason why nobody else is talking about it. The guys on Wall Street don't care. They are not in the stock market to make long-term returns. Half of Wall Street is there trying to trade in microseconds, buy, sell, because these are the kinds of people that offer absolutely nothing to society, produce absolutely nothing, and want to pretend that their gambling addiction is an actual job. The other half of Wall Street manages other people's money. And people who manage other people's money do not make money from stocks going up. They don't care. They make money by getting more people to give them their money to manage, because the fund managers then make a fixed percentage of that money as their fee. So the only thing that they care about is talking about whatever's trending, whatever's popular, which is incidentally also what all of the investor bros on Twitter and the real estate agents with a small PP do as well. When the stock is down, the sentiment is negative. They go posting videos, making tweets saying the company sucks, everything sucks. They are selling all of their stock, they are shorting the stock, and the management sucks and blah, blah, blah. Then 2 weeks pass and the sentiment shifts, and those same people go and quickly delete all of that stuff that they said and immediately go and tell you that they knew all along that the stock would go up. Well, of course, they are bullish or whatever. These idiots just keep playing the same game over and over and over, and instead of doing that, I want to share something really interesting and a bit insightful with you instead. First, it's important to understand that the stock market crashed in 2022 and has not yet recovered. But Sasha, the stock market is near its all-time highs, but this is only because an AI hype wave that is affecting a very small number of stocks is covering up the actual overall numbers by those companies doing ridiculously well with stock price while everybody else is suffering. Here is a comparison between the S&P 500, the orange line, and Russell 2000, the blue line. In case you don't know, Russell 2000 is an index of small cap US companies ranked from the 1000th to the 3000th company by size. So the methodologies between the S&P 500 and the Russell index are a bit different, but roughly speaking, you have the S&P 500, that's the 500 largest companies by size. Then you have this little gap of 500 companies. And everything below that, the next 2000, that's the Russell 2000. So the Russell 2000 index crashed around 33% starting in late 2021 through to 2022. The S&P 500 also fell, but only by 25%. And you can see that in the last year, the S&P 500 has been absolutely exploding, with AI stocks pulling the overall index up. But the Russell 2000 index is still roughly 19% below its peak back in 2021. Amid higher interest rates, smaller companies have a harder time issuing bonds compared to bigger companies. They're also more likely to borrow at a floating interest rate. One Goldman Sachs analysis found nearly 33% of Russell 2000 debt is at a floating rate compared to just 6% of S&P 500 debt. Pretty interesting data, but of course you'd already know all of this if you read the Daily Upside, who are the sponsors of today's video. The Daily Upside is a completely free daily newsletter bringing you the very best of financial news every morning. The stories are short, they are written by industry professionals, which means that they actually make sense, unlike the vast majority of finance media, and they come with a very satisfying serving of sarcasm, which I obviously really disapprove of. It takes 5 seconds to sign up to the Daily Upside. It's 100% free, and all you need to do is just type in your email. There is no upsell, nothing that you need to pay for. It's just an awesome summary of the most important finance news that you can read over a cup of coffee. Use my link in the description or in the pinned comment to join over 1 million other readers, including me, today. So a few weeks ago, everyone was panicking because inflation data came out, and it was once again artificially high because of the lagging shelter indicator. Without shelter, inflation in the US has been give or take at 2% since June last year. We're almost a year into this period. But after the inflation data, Jerome Powell, the chair of the Fed, came out and said that rates aren't coming down anytime soon, and everyone started losing their marbles because the chair of the Fed doesn't understand data. I know, sad times. But then something changed. The S&P 500 is up 8% so far this year, and in just the last week, it reversed that decline with a 3% increase. And a lot of this is down to us entering a new earnings season. A lot of the big tech companies are posting extremely strong results, and these results are showing very powerful data beyond the profit and loss numbers. Google beat market expectations with a very strong first quarter, but the really interesting data, the important data, in my opinion, is all in the detail. Here is my valuation model for Google, and by the way, I share all of these with my members in my Discord in case that's something that you want to check out. But here is something really basic. This is the year-on-year increase in the revenues generated by each of Google's business segments. So in 2022, the economy began imploding, and so did the stock market. The stock market fell 25% from January to October 2022. And you can see in Google's data that all of the performance numbers for Google collapsed throughout 2022. In fact, they started falling a bit before the stock market started falling. The reason this is important is that Google makes money from ads. 80% of Google's revenue comes from ads. Google are the biggest advertising company in the world, and it is quite unusual. We've never had a crash before where you had such a dominance of a single advertiser at the same time as the crash was unfolding, and you could see the data very clearly from that advertiser in the same kind of way because we now have these online ads. And half of Google's entire global revenue comes from the United States. So Google's numbers are like feeling the pulse of the US economy. When companies are seeing their sales fall, when they're struggling, they cut back on ads and all other non-essential spending because they aren't making a return on those ads. People are not buying. So when the economy goes shit, ad spending goes down, it collapses. And in Q4 2022 and in Q1 2023, we saw the bottom where Google's ad revenue was posting negative growth. And for a second, let me switch out to the Truflation chart. This is a measure of US inflation that tries to use more realistic numbers that are more up to date and accurate than the Fed's numbers without lagging indicators. And you can see that in May 2023, 12 months ago, inflation collapsed according to those numbers as well. It was obvious from the data at the time. I was talking about it right here on this channel, and I know that inflation is a divisive topic. I get loads of comments, and just because inflation collapsed does not mean that prices got cheaper, does not mean that things got easier. It just means that the prices are growing more slowly. So a lot of people wouldn't even have noticed that inflation stopped a year ago because they are still getting used, they're still catching up to the huge price increases that happened back in 2021, 2022, and early 2023. Sure, there are some problems right now. Car insurance prices, energy prices, etc. But the overall numbers are in a much better position. You can see that suddenly from Q2 2023, things began improving. People began spending on ads again. The top two lines here are the two main ad revenue streams for Google, Google Search and YouTube. And you can see that every quarter since that bottom, the numbers have been bouncing back, getting better and better and better, including the most recent results that just came out. The most recent quarter, ads are up 14.4% on search and 20.9% on YouTube. And by the way, this is really interesting. When companies stop advertising, they cut their advertising budget, starting with the ads that are the most difficult and time-consuming to produce, the most expensive to produce, the ones that are the most volatile in terms of results. So you can see that at the bottom, ads on YouTube go down way more than ads on search because people will cut ads on YouTube before they cut ads on search. But then you also see the reverse happen when times are good. When companies open up the spending again, YouTube gets a disproportionate increase in ad revenue. So it yo-yos a lot more. And if you look at the other ad companies like Meta or Pinterest or whatever, you get exactly the same story. Here are the numbers for Pinterest. These are even more accurate, by the way. This is the revenue per user. So it's purely showing you the rates that people are paying for ads taking out the user growth from the data, and you can see how Q4 2022 and Q1 2023 saw a huge slowdown in ad rates at the same time as we saw those numbers for Google. But the numbers have been going up since then. The thing with ads is that ad spending comes months or even quarters before it translates into revenue for the company spending that money on ads. First, the company has to go and spend the money on the ads. Then people need to see the ad a few times before they go and decide to spend. Then they go and spend the money and the company earns the revenue. And then we have to wait 4 months to see that revenue on the profit and loss statement at the next quarterly earnings report. So this ad data is probably running something like 3 quarters ahead of it showing up in the performance data. And this performance data is the real deal. This is not an AI-influenced artificial stock market pump. This is real people buying real things. This is real companies spending real dollars on advertising. People buying things from big companies, but also buying things from small companies who are all advertising on the same platform. And many of those small publicly listed companies are still sitting there with their stocks destroyed in 2022 and still have not yet recovered, because new money flowing into the stock market has been flowing into AI. You know, the thing that everyone wants apparently, the fashionable thing. The concentration of value in the stock market has shifted to the biggest stocks. The 6 biggest companies in the stock market now make up 28% of the S&P 500. The 2,000 companies in the Russell 2000 index have a combined market cap right now of about $3 trillion, which means Microsoft's valuation alone is bigger than all of those 2,000 companies combined. Today, news came out that worker pay rose more than expected in Q1, in another sign of persistent inflation. Because you see, everyone is looking at this number here. Pay increased 1.2% in the first quarter, which was higher than the 0.9% increase in the quarter before that. And here is this same data. When you zoom out, you can see that the employment cost index is slowly making its way down. You wouldn't know it from the headline, but that's what's happening. The media is absolutely freaking out because it's not making its way down fast enough. But back in 2018 and 2019, this index sat at 3%. Today, it's at 4.3% after the biggest inflation spike in a generation, and interest rates now sitting at 5.5%. When people have to feed their families, pay their bills, and pay interest on their debt, no shit, wages are having to go up a bit more. But there is nothing concerning in this data. There's nothing particularly unusual. If you don't spend your time looking at every single microscopic inflection with a magnifying glass. For me as an investor, I'm looking at all of the different data coming in, and I see this. The stock market crashed back in 2022. I know a lot of people don't like the term crash, but it collapsed by 25% from January to October, and it would have collapsed more, maybe by around 30 to 35%, if ChatGPT didn't turn up in Q4 2022. Because as soon as ChatGPT came out, AI stocks began taking off to the moon, which made the overall numbers look better than they were. So now we are going into May 2024, almost 2.5 years since the stock market peaked in the last week of 2021. Many of these smaller companies have still not recovered, are still at the bottom in terms of their stock price. 2.5 years later. This is actually quite unprecedented. If you look at all the stock market crashes in modern economy since World War II, the longest sustained crash was a dot-com bubble. It took 2.5 years to reach the bottom, and then another 4.5 years after that to break even, just before the financial crash happened. But if you go and study history, stock market crashes, typically, on average, the vast majority of them do not take that long to recover. Almost every single major crash on this chart recovered in about 2 to 3 years. We are here at the top right now, but if you ignore the impact of that small handful of AI stocks, the recovery gap is now at that same point where the average stock market crash, the typical stock market crash, has that V-shaped rebound. We know already from the inflation data, from ad spend data, from wage data, from productivity data, from some of the internal company performance data, that the economy is rebounding hard. We can see it in the numbers. People are investing. Companies are investing unprecedented amounts of money again. But a lot of that data comes 2 to 3 quarters or longer before you see it come out in performance data. People are working hard right now. They're spending money right now. They're putting in the effort. They're spending money on ads right now. But you'll only see the results of that work down the line. Now, I'm not old. but old enough to have seen some of the boom and bust cycles. But I haven't seen a time personally when I felt the opportunity for investors was as good as it is right now. You have this huge selection of stocks selling at massive discounts still, while every trend, every data point is pointing to a very sharp recovery. I know that dimwit finance YouTubers with a gambling addiction will do their best constipated face in the thumbnail to tell you how bad everything is. Oh my god, please panic, because that's the trend right now. That's what all the media is saying. That's the popular narrative. That's the commonly accepted sentiment. But you should never base your investing decisions on what the sentiment is or on what some random guy on YouTube said. This is all irrelevant noise.